Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary entitled this week, Should We Be Worrying About Inflation? We're upgrading our US growth number from an already robust 4.2% to 6% or beyond, a blistering number. What's driving this? Well, not just reopening, but the size of the stimulus plans. We had in December Trump's own plan in the last days of his White House, $900 billion. We now have Biden's American Rescue Plan, $1.5 to $1.9 trillion of stimulus, the second largest in US history. Put the two together and $2.4 trillion, that's 10 to 15% of US GDP spent in a single year. So you see the sort of impulse that's coming from the White House. Add to that the global stimulus plans, over $20 trillion it's estimated spent this year by governments around the world, almost a fifth of GDP. Add together the reopening trade and you can see the sort of momentum that's now behind the economy. What does this mean for interest rates? But more importantly, what does this mean for inflation? Are we indeed looking at the first policy era of the new Biden administration? Let's start by looking at the progress of markets in 2021 to date. Emerging markets still the leaders, up 5%, but well off their highs of a few weeks ago. UK equities, a comparatively strong performer, up 4% compared to world equities, which are actually down 1%. UK gilts down nearly 6%, along with other global bond markets, as yields rise around the world. On the right-hand side, you can see the trajectory of commodities, extremely strong in oil. This is this price pulse that we talked about earlier in the talk today. Copper, nickel rolling over. Gold noticeably 10% lower for the year, an extraordinary change from 2020. So against this is sitting this US inflation backdrop, which is rising as the Biden administration's fiscal program begins to fall into expectations. It's our opinion that this triumvirate, Biden at the White House, Yellen at the Treasury, Powell at the Federal Reserve, are all aligned together to try and create sufficient momentum in the economy, almost escape velocity, to limit any permanent damage from the virus. Remember, of course, they want to be very different from the last financial crisis. Biden was vice president under Obama and saw how long that dragged out the underlying recovery and the recovery in jobs. In addition, of course, the US public have increased their savings extraordinarily, almost 2.5 trillion savings in excess of the levels they were at before, which will flow back into the economy once we reopen. So these effects are all coming together. Let's look at that in chart terms. On the left, I have total US savings right back to 2002. You can see almost 2.5 trillion of additional savings, which of course will flow back into the underlying economy. On the right-hand side, you can see that in income and expenditure, personal income rising in the crisis because of government stimulus checks flowing into your bank account, and personal consumption expenditure much weaker because of lockdown. Exactly the same picture we have in the UK and across Europe. Secondly, of course, there are additional pricing pressures we have to deal with because supply chains have been upset. This ISM index, which we've looked at regularly in these videos, the best probable indicator of the pressures in manufacturing. I've shown how their prices paid index above 50 shows prices rising. At 86, that's the strongest number since 2008. So that supply chain really being squeezed post the virus. On the right-hand side, you can see the surge in inventories, which initially sat on prices in the early days of the crisis, sharply reversing, with inventories in factories around the US now below the average number. It's not all good news, and it's not all inflationary news. We still have 9 million jobs lost from the crisis, as you can see in 2020. But that recovery much, much faster than anything that we saw under the Obama administration after the financial crisis. Again, very high in Biden's thinking. On the right-hand side, we've also got underlying damage still, particularly to the more lowly paid. You can see job loss is still material, that light blue line, for the lowest wage groups. And they, of course, will be sitting on pricing, and there'll be surplus labour both here and across the world, which will tend to cap inflationary pressures coming out of the crisis. Let's summarise this with a probable view that US CPI hits 3%, possibly slightly higher as those oil prices pulse through, coming back to 2.25% by year end. So not a hugely material upshift in inflation, but enough to worry financial markets, enough to call into question the credibility of the Federal Reserve with their targets of only raising interest rates at end 2023. I think that's the dilemma that the market is currently dealing with. Very briefly, the picture for the UK. Well, I've showed the famous fan chart from the Bank of England showing inflation expectations rising from the 0 to 1% firmly to the 2 to 2.5%, not that different from the US. Two extra factors for the UK: one, tighter supply chains post-Brexit, which will push up prices, I'm sure, and secondly, the upward move in sterling, which is positive. If flows continue to come back into the UK economy, post the UK-EU trade accord, you can set that upward pressure on sterling to sit on inflation. So probably more finely balanced ultimately than the US, but coming out as a similar number. So in summary, we are not yet seriously concerned about inflation. We see the increase in pricing as probably a good thing, a sign that economies are recovering. But the challenges for financial markets is how central banks respond, and can the authorities keep their credibility? That's important because we've got the biggest bond issuing program in history to fund the recovery coming down the pipe in every country across the world. Well, I hope that's useful. Thank you.